Hello, this is part 3 of chapter 11 slides. Oh, you saw my funny picture already. Here we go. All right, so we're still talking about section 1231, right? So these are depreciable assets or land used in a business held for more than a year. All right, we've seen that if I sell an asset at a gain, I have to take any of that gain that's due depreciation and recapture it as ordinary income. If I sell it at a loss, it's just called a 1231 loss. And if I have a net 1231 loss, it gets counted as an ordinary loss, which the taxpayer likes, right? Ordinary losses are more valuable. All right, so, right, but if I have gains and losses in the same year, I have to net them together, right, which will make the gain or loss smaller. So a clever taxpayer might say, these 1231 losses are valuable. So I'm going to sell my loss assets at the end of year 1 and deduct the loss. Then I'll just wait a little bit, and in the beginning of year 2, I'll sell the gain assets and I'll get the preferential gain treatment. All right, Congress figured out that people were doing this and they said, not so fast. Let's do that one more time. This is my favorite GIF. I don't know if this is real life or a movie or what. Okay. So what you have to do is called a look back, because whenever I end up with a net, right, I've netted things together and I have a net 1231 loss, I have to look back to the prior 5 tax years. If in any of those years I had net, I think I misspoke at the beginning, right? So if at the end of if in the current year I have a net 1231 gain, right, which I've already done the depreciation recapture, so I'll have this gain that's going to be treated as a long-term capital gain. Now, first I have to look back over the prior 5 tax years. If any of those years I had a net 1231 loss that gave me an ordinary deduction, and I haven't ever recaptured it yet, now my gain in the current year has to be recaptured to the extent of those losses, and it will become ordinary income. So there's 2 ways that my 1231 gains can get turned into ordinary income. One is the depreciation recapture on each asset. And now 2 is this look back, right? That's going to be on my net 1231 gain of all my assets. All right, so once again, the amount of the gain doesn't change, but the character does, right? We're taking it and turning it into ordinary income. All right, once I've done this once I've looked back and recaptured a loss, that loss is now recaptured and I won't ever have to look back at it again. We had, right, just FYI, we have some of our 1231 gains are also called 1250 gains from real estate that haven't been recaptured. These ones, if I'm looking back, those 1250 become ordinary first before I do the other 1231 gains. So both of our recapture rules are saying, in the past, you've got ordinary deductions. You either got depreciation deductions or you got a net 1231 loss that was an ordinary loss. All right, we're gonna balance that. Since you got deductions against ordinary rates, we're gonna make you match those now with gains taxed at ordinary rates. All right, so the idea here is balance. I was trying to put in a funny Star Wars meme here about bringing balance to the Force, but I just felt like a nerd. All right, so here's an example, but this will make more sense after we go through an example of what we mean by look back. All right, so Joan went through, she sold some assets on each one, right? She recaptured depreciation if she had to, netted gains and losses together. She ended up with a net 1231 gain of $5,000, right? So net gains get treated as long-term capital gains, except first she has to look back, right? And so these are her net 1231 gains or losses over the prior 5 tax years from newest to oldest, right? So currently it's 2019. These are the prior 5 years. So what do we mean by unrecaptured 1231 losses from the prior years? So in 2014, she had a net 1231 loss of $3,000. She got to deduct that as an ordinary loss, and now that becomes an unrecaptured 1231 loss going forward. The next year, she has a net 1231 gain. So that year, she's going to look back. She looks back and she sees this unrecaptured loss. So to the extent of her gain, now all of her gain, she has to look back because she got an ordinary loss from 1231. Now this net gain becomes ordinary because she's now recaptured 2,000, all right, up to her gain. There's only 1,000, this 3,000, 2,000 of it has now been recaptured. So there's only 1,000 left of unrecaptured 1231 losses at the end of the year. The next year, she has another $2,000 net 1231 gain. So once again, she's going to look back. So looking back over the prior years, the amount of 1231 losses that haven't been recaptured yet is 1,000. So 1,000 of this $2,000 gain is going to become ordinary income because of the look back rule. The other 1,000 of this will just be a 1231 gain. Now, there we go, 1231 gain from that. Right, this is the part of the 1231 gain that finally survived after not being recaptured, and it gets treated as a long-term capital gain. Because she's now recaptured the rest of this 1,000, she ends the year with $0 of unrecaptured 1231 losses. 2017, she has another net 1231 loss from sales during 2017. All right, so she gets to claim it as an ordinary loss, and right, it just happened this year, so it hasn't been recaptured yet. She ends the year with 4,000 of unrecaptured losses. In 2018, if she has a $3,000 net 1231 gain, all right, now she's going to look back. She has this 4,000 of unrecaptured losses. So the entire gain, right, is going to be recaptured as ordinary. And there's still another 1,000 out of this 4 that hasn't been recaptured yet. So now if we're in year 2019 and she had a net 1231 gain of 5,000, she's going to look back, and from the prior 5 years, she has this 1,000 that hasn't been recaptured yet. So that 1,000 will become ordinary income. The other 4,000 out of this 5 is still a 1231 gain, right? So it gets treated as a long-term capital gain. So that's the look back rule. It's a little bit convoluted, so I find it easiest to really make a chart and keep track of everything to see what I've already recaptured and what I haven't. All right, so here, let's put everything together now that we've learned about 1231 assets. What's our process? All right, so on each asset, one by one, as I sell it, I'm going to calculate the gain or loss. And then I'm going to say, all right, if it's a related party, that entire gain is ordinary and a loss can't be claimed. All right, but if it's not a related party, then, and it's personal property, I have to recapture any of the gain that was due to depreciation. So the lesser of accumulated depreciation or the gain is ordinary income. Anything that's left will be a 1231 gain. So now I might have some 1231 gains and some 1231 losses, right? If I have one asset and it's a 1231 loss, I don't have to recapture it. It just goes. Now my losses and gains will get netted together. If I end up with a net 1231 gain after that, it's treated as a long-term capital gain. but remembering that some of those could come from real estate depreciation, and I'm going to call those 1250 gains, right? They're still in here, but they might get taxed at a higher rate. If I end up with a net 1231 loss, it's an ordinary loss. Something that we haven't noted here is if, right, I have a casualty loss, so an accident or a fire damages or destroys my asset. A casualty loss doesn't have to be netted against other 1231 gains and losses. If I have a net casualty loss, I can just claim it as a loss that year as an ordinary loss, right? Something bad happened, we want them to get relief from that casualty. If, right, maybe insurance reimburses me and I have a net casualty gain, I'll just treat that, right, after I net it with any other casualty losses, then a net casualty gain just gets treated with my other 1231 gains. Right, finally, right, if I had a loss here, I already claimed it after I netted gains and losses together. If I ended up with a net gain, then one more step is I have to apply the look back, right, over the prior 5 years if there's any unrecaptured net 1231 losses from those years, right? So those, to the extent that there are unrecaptured losses, then my net gain from the current year becomes ordinary income, and that's going to come out of any 1250 gains first. So an example, Zing Company had the following gains and losses from 1231 property, right? So this was depreciable assets or land used in a business for more than a year. All right, some of this was from a casualty they had. Let's say there was an earthquake. All right, one of their, that casualty resulted in one gain and one loss. And then they had another gain and another loss from just selling assets during the year. All right, so we're assuming here, right, that doesn't tell us about depreciation. We're assuming on each one of these, they've taken any depreciation that caused a gain and they've recaptured it as ordinary income already. And this is what we're left with. So first, I want to net the casualties separately. Since they come out to a gain, I'm just going to combine them with everything else. So here, right, when we add the net casualty gain and this loss, we end up with negative $7,000. All right, so since it's a loss on my 1231 assets, this is just a net 1231 loss. Net 1231 losses get treated as ordinary losses, which is good. So that's what happened to Zing in year 1. Now in year 2, they have, another casualty, and they have another 1231 gain and another 1231 loss. Since they only have a net casualty loss, right, and no gains, they get to claim this as an ordinary loss, right? No matter what else is going on here, they just get that relief from their casualty. So that becomes an ordinary loss. Next here, we're going to net the 1231 gains and losses together. Gives us a number of positive 27,000. Right? Once again, we're assuming that the depreciation recapture has already happened here, and this is what we're left with. Now my next step, once I've finished netting my 1231 gains and losses, is I have to look back. Now we know from the prior slide that we're assuming prior slide was the first year of their business. They had a net $7,000 1231 loss, right? So that just happened last year. That has not been recaptured yet. So when they look back, they see 7,000 in unrecaptured losses. That means of this $27,000 net 1231 gain, they look back and 7,000 has to become ordinary. The rest of the 20, now it's finally survived all of the recaptures and it gets treated as a long-term capital gain. right? This ordinary income is going to be offset by that casualty loss, and they'll end up with a negative $1,000 loss. Let's do another example. Green Building Company in 2019 has the following transactions. They have a $5,000 loss on the sale of equipment used in the business for 3 years. All right, so we know losses I don't have to recapture, and I'm just going to call this a $5,000 12/31 loss. They had a $35,000 gain on the sale of a building used in the business for 5 years. Right, so these were both business assets used for more than a year. They're 12/31 assets. The building is also a 12/50 asset because it's real estate. And they're tell us that 10,000 of this gain is attributable to depreciation, making the basis smaller. So of this 35,000, let's see, I'm going to take 10,000 of it. I'm not going to recapture it because it's real estate. I'm going to call this $10,000. This is an unrecaptured 12/50 gain. All right, so that's 10 out of the 35 that was due to depreciation. The rest, right, the other 25,000 is because the building actually went up in value. So I have a 25,000, right? And since it's not due to depreciation, this is just called a 12/31 gain. They had another $15,000 loss on the sale of land used in the business for 2 years. That's a 12/31 asset. Since it's a loss, it's just a loss. And since it's a 12/31 asset, it's a 12/31 loss. All right, so if I net these together, right, this is technically, right, this is also a 12/31 gain. When I'm netting, this gain could get reduced by losses, but it's going to be the last one. I'm going to keep it separate as long as I can. So when I net these together, I end up with a $5,000, right, net 12/31 gain. And then I also have this $10,000 unrecaptured 12/50 gain, right? So I'm ending up with 10,000 here and 5,000 here. My next step then is to look back. They tell me that over the previous 5 years, these are their net 12/31 gains and losses each year, right? So I'm going to keep track of what's unrecaptured. So at 2014, they had a net 12/31 loss. Well, it just happened that year, so it hasn't been recaptured yet. The next year, they had another net 12/31 loss. So now there's 30,000 of losses that haven't been recaptured. In 2016, they had an $8,000 net 12/31 gain. Well, that's going to become all right. They're going to look back and see these unrecaptured losses. That's all going to become ordinary income, which means now there's only 22,000 of unrecaptured losses. Now the next year, they have 27,000 of net 12/31 gains. Well, they're going to look back. They're going to see 22,000 of unrecaptured losses. So they're going to have 22,000 ordinary, and they're going to have the other 5,000. I know that's terrible. 5,000 is a 12/31 gain, right? That gets treated as a long-term capital gain. Right, so now they've looked back and they've recaptured everything. They're going to end the year with 0. The next year they had 7,000 of unrecaptured of net 1231 losses, and so they're going to end 2018 without those being recaptured. We've got 7,000 of unrecaptured losses. So now when we're coming up here to 2019, right, we've netted everything and characterized it. We have to look back. We're going to look back and see $7,000 of unrecaptured 1231 losses. All right, so that is going to come out of here first, out of the 1250, which is good for you. These were going to be taxed at a higher rate than these. So if I have to turn one into ordinary, it'll do these. So this is going to become 7,000 ordinary, right, due to the look back. And the remaining 3,000 is still unrecaptured 1250. All right, so in the end, we're left with this 3,000 unrecaptured 1250, 7,000 of ordinary, and 5,000 net 1231 gain. These are going to be taxed obviously at ordinary rates. These are going to be taxed up to 25%. And these are going to be taxed as long-term capital gains at 0, 15, or 20%. I think if I go to the next slide, right, repeat what we did here, right? If I net my 1231 gains and losses, and I also had the $10,000 unrecaptured 1250. When I look back, I had those 7,000 unrecaptured net 1231 losses. So that makes 7,000 of this become ordinary, leaving 3,000 unrecaptured 1250 and a $5,000 long-term capital gain. All right, so the real estate part, right, gets taxed up to 25%. Net 1231 as a long-term capital gain, and the ordinary income at ordinary rates. All right, so some things that, right, we can remind ourselves about this section 1245 recapture. It doesn't apply to losses. Losses, a net loss each year is an ordinary loss, right? But that could have to be recaptured in a future year, right, through look back. If I sell 1245 property, right, this is personal, depreciable personal property used in a business. Most of the time it's going to be ordinary income because a gain on that property is only because depreciation made my basis smaller. It would be rare for those a used business asset to actually increase in value. If I've held a business asset for a year or less, it's going to be ordinary income. All this special treatment only applies when it's been more than a year. It's long-term assets. All right, if we remember in chapter 10, we didn't just have the regular depreciation, we had immediate expensing, we had section 179 immediate expensing, and we had bonus depreciation. All right, that counts as depreciation. That has to be recaptured if we sell an asset and have a gain. Those amounts have to be recaptured as ordinary income too. All right, let's do another example. We had a rack that cost $100,000, 60,000 of accumulated depreciation, and it was sold for $135,000. All right, so these are all going to be, all right, so this company, Green Industries, sold all of these during the year. They're all depreciable assets or land used in a business for more than a year, so they're all 1231 assets. All right, so I can see here, I can eyeball, because I sold this for $35,000 more than I paid for it, I know that true appreciation is going to be a 1231 gain. I know that the basis is going to be cost minus accumulated depreciation, my basis was 40,000. So my actual gain is 95,000. But 60,000 of that is only due to depreciation. That amount gets recaptured as ordinary. We had a forklift that cost 35,000 and we sold it for 5,000. The accumulated depreciation, right, is going to be 35,000 minus 23 or 12. So I'm going to take amount realized minus my 12,000 adjusted basis, right? Once again, that's my initial basis minus the depreciation. And I'm going to have a $7,000 loss. No recapture on losses on an individual asset. And so this is just a 1231 loss. On this one here, it cost 87,000 and I sold it for 60,000. So I know there's no true gain. So there's not gonna be a 1231 gain. My basis is gonna be $87,000 initial minus accumulated depreciation. That's 53,000. All right, so I'm gonna go amount realized, right, minus my basis equals a $7,000 gain, right? The smaller of my gain or my accumulated depreciation is, right, recaptured as ordinary, right? I can see all of this gain happen just because depreciation lowered my basis. All right, the problem tells me, all right, so that I don't, when I look back, if I do the look back, there's no losses from prior years. So there's nothing that I have to do with look back. I can net these together, right? I'm gonna have the 60,000 plus 7,000 of ordinary income. And I'm gonna net the 1231 gain and loss together, leaving me with 35 minus 7 is a $28,000 net 1231 gain. Since there's no look back, it gets treated as a long-term capital gain. So I have a $28,000 tax as a long-term capital gain, 67,000 of ordinary income. All right, so I can plug everything in here that I did. All right, you'll have this in your slides, right? You can see, right, I get the gain or a loss, and I recapture anything from depreciation on the gains, and a net 1231 loss is just a 1231 loss. So as we said, we ended up with 67,000 of ordinary income from recapture and 28,000 of net 1231 gain. Right, since we've survived all of our recapture hurdles, that 1231 gain gets treated as a long-term capital gain. So here's a nice graphic from the book that gives you a decision tree where you can figure out the proper treatment for any sale of asset use in a business. Right, yeah, this is a mess. It's kind of cool, but right, it takes into account a lot of things that we don't really have to worry about most of the time. This is a better picture right here. All right, my 1231 netting process, right? On each individual asset, if it's a gain, I have to recapture depreciation. If I have a gain left, right, a loss, I don't have to recapture. So I'll net losses with any remaining gains. If I end up with a net loss after that, it's just an ordinary loss. If I end up with a net gain, I have to do one more step. I have to look back from prior years. If there's any unrecaptured net 1231 losses, those turn into ordinary income. Anything that's finally left after that gets treated as a long-term capital gain. All right, we'll stop there for this unit, and we'll have one more section of chapter 11 slides after this.